On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope you are all well. Today I wanted to talk about what's happening in Japan and why investors need to watch Japan very closely this year because it could impact all of us elsewhere. Now, while every country in the world, just about, has been reducing interest rates from multi-decade highs, Japan has been doing the exact opposite, and this is really interesting, and it matters for everyone. Now, the Japanese economy isn't as dominant on the global stage as it once was. Its share market these days is about 4.8% of world share indices. However, it is a critically important region when it comes to global financial markets, especially for things like foreign exchange and for bond yields. So we need to keep a close eye on how the landscape is changing in Japan and what it might mean. We need to do a bit of a history lesson first. So let's go back to the 1980s. Japan had a genuine rock star economy back then. You had new infrastructure, you had productivity gains from the decades following World War II. So very high quality goods were being built in advanced factories, and that saw the economy really boom in the 80s. You also had all those reliable fuel efficient cars, Toyota Corollas, Mazdas, Hondas. Japan was producing all of those great vehicles back in the 80s, and they were a real hit globally after the oil shocks of the 1970s because they obviously used a lot less fuel and they were a lot more reliable and a lot more efficient. So all of this fueled a massive property and share market bubble. The Nikkei share market index in Japan tripled in just 4.5 years, and Tokyo real estate was reportedly selling for more than 350 times the equivalent in Manhattan. And at its peak, the land under the Imperial Palace in Tokyo was notionally worth more than the entire state of California. You had a very strong US dollar that was also making Japanese goods more attractive to American consumers because the American dollar went further over in Japan because they could buy more. And all of this was putting huge pressure on the US manufacturing sector, and it led to a large US trade deficit. So then you had the Plaza Accord agreement in 1985, and that saw the world's biggest economies try and do something about that dynamic. And in the aftermath, the greenback weakened sharply against the Japanese yen. So that was deliberate on the part of the US, and it did help reduce the trade deficit in the United States, but in turn it made life difficult for Japanese exporters, who up until that point had had a pretty good run. So to offset that tougher export environment in Japan, Japanese policymakers introduced expansionary monetary and fiscal policies, and they contributed to that sharp rise in asset prices. The bubble ended up bursting in 1990, and that sent property prices, share prices into pretty much a 30-year slump. And at the lows in 2009, the Nikkei index was more than 80% below those heady days of 1989, and it didn't retake those levels. It didn't go back to those 1989 highs until 2024, many years later. So Japan's economy was plagued by deflation in those lost decades, which is how people describe that period. So in the 35 years following 1985, consumer prices went backwards in 12 of them in Japan. 12 years out of 35, that's a lot. The annual inflation rate over that whole period was just 0.5% in Japan, compared with 2.5% in the US and 2.9% in New Zealand. And deflation means that prices are falling rather than rising. So inflation is prices going up. That's what we're used to. That's what we've been battling with here in New Zealand and in the US and in Australia for the last few years, and that's normal. Deflation is when prices are going backwards, and that isn't nearly as good as it sounds. Consumers stop spending money because why would you buy something? It'll be cheaper next month after all, and businesses become reluctant to invest or grow. People start hoarding cash, the economy grinds to a halt, and it's a really difficult hole to climb out of. And for central bankers, for the Reserve Bank, the Federal Reserve in the United States, inflation is a problem, but it's one that they know how to deal with. When inflation is too high, they just put up interest rates and it will slow the economy and it will put downward pressure on inflation. There will be consequences, as we all know, but at least they do have a solution. Deflation, really, really difficult to deal with, and that's why you end up in a big hole that takes a long time to climb out of. And that is what Japan has been dealing with for the last few decades. So while the rest of us have been trying to knock inflation on the head, Japan has been trying to create inflation, and it's finally been working. In early 2024, the Bank of Japan raised interest rates for the first time since 2007, and that ended an 8-year stretch of negative interest rates. They had negative interest rates because they were trying to desperately generate some growth, some spending, and some inflation. And since then, since early 2024, they've hiked interest rates 3 more times. And that has taken their policy rate, their equivalent of our official cash rate, to 0.75%. Not much, is it? 0.75%. Super low for an OCR or a policy rate. And as low as that is to the rest of us, that is actually the highest we've seen in Japan since 1995, 30 years ago. More conventional monetary policy settings have been good for Japanese shares. They've had a cracking 3 years, and the Japanese share market is actually up more than 85% since the beginning of 2023, so just over 3 years. That's seen it outpace even the mighty S&P 500. So we've all been talking about AI and the US stock market and the S&P 500 these last 3 years. You actually would have been a little better off to put your money in the Japanese share market. It has been that good. We've seen some really big moves in bond yields too, interest rates, government bond yields. The 10-year Japanese government bond, they call those JGBs, Japanese government bonds, the 10-year JGB yield has pushed above 2% again, very low, just 2%. But that's the first time we've seen it above those levels since the 1990s. And that is a really big deal, and one that could ripple across other markets too. Because when you had near zero interest rates in Japan, the yen was the funding currency of choice for decades, really. People would borrow money in Japan for next to nothing. They would invest that money in a higher return asset somewhere else in the world, and they would pocket the difference. And the difference is what they call the carry in market lingo. So that's why they call it the carry trade. Japan now has really been the last domino to fall, and those higher JGB yields now mean that that era of free money is officially behind us. So with rates looking more attractive in Japan, you could see the yen depreciation reverse, because the Japanese yen has been weak for a long time because you've had those negative interest rates, you've had that weak economy. That could see some of those carry trades unwind. And less Japanese funds flowing into global assets could put upward pressure on yields elsewhere, such as in the United States. So there's every chance that the Japanese share market keeps performing well against this backdrop, and many strategists and analysts out there think that Japanese shares are still well positioned to do well in the future. But you could see changing sector leadership across other markets around the world. So some of those sectors that perform very well when interest rates are low, like high growth companies, they could face a few more headwinds, while the so-called value stocks, things like financials, things like industrials, they could fare a little bit better. Now, these moves could also mean increased volatility in other assets that are reliant on cheap money, such as crypto. So, we do need to keep an eye on this whole dynamic and what's happening in Japan. The Bank of Japan meets 8 times this year. The first meeting of the year is scheduled for later this month. I think it's on Friday, the 23rd of January, if I'm not mistaken. And over the balance of this year, markets see at least one, maybe two more rate hikes over the period. That could change as you get inflation figures, as you get growth figures, but right now, that's what markets are expecting. And that doesn't sound like a lot. Those are pretty modest increases, aren't they? However, what we've seen in the past is that they could have a bigger impact than many people expect. So we would all be very wise to pay attention to what is happening in Japan, because today's level of leverage, high debt levels in places, as well as the world's interconnectedness, I think that's a word, could see these ripples turn into waves for some other parts of the financial ecosystem. So keep an eye on Japan. Even if you haven't got money invested there, what's happening in that part of the world could ripple through other financial markets. If you want to know more, or if you want to invest in Japanese shares, because like I said, a lot of people think that that market is well positioned, and it's certainly been going well these last few years, talk to an investment advisor and get some advice. That's all for today, team. Thanks for listening. We'll talk again soon.
For more insights, visit craigsip.com.